Hello, hello. Abel Pacheco here with the Five Talents Podcast. We are super excited today. Mr. Nima Nima Reza. How's it going, brother?
I'm doing well. Thank you very much for having me on your show, sir.
Yeah, brother. I'm excited and thanks for joining us. As I mentioned earlier, if you don't know who Nima is, he's an amazing individual with a quite an extensive background. Real estate, business tax, generational real estate, wealth creation, wealth preservation, and we're excited to have him on our show. So Nima, in your own words, let me turn it over to you, brother. Tell us a little bit about who you are and what you do, and we'll just start a great conversation here.
Thank you very much. I appreciate that. So yeah, my name is Nima Rezaei. I'm a CPA out of Northern California, Sacramento area is where my office is. But I mean, I have clients all across California and other states as well. I am a CPA with a valid license in the state of California. I'm also an MBA. I got my MBA with an emphasis in accounting from Sacramento State. And yeah, so I love this field. This is a field that just kind of fell on my lap. And there's been no turning back ever since I jumped on it. So I've been in public accounting for a number of years now, accumulated experience in all kinds of public accounting experience, like everything from sales tax, payroll, obviously to tax planning, and obviously real estate is a big one that I deal with a lot of clients that have real estate investments and need real estate strategy. So it's something that I've been doing and something I'm going to be doing. Started my own practice recently out of Roseville, California, which is like a suburb of Sacramento. And yeah, things are great. I love it. Thank you. Thank you very much.
Yeah, man. Thanks for having us. So let's start first before we dig into the numbers. How did walk us through a little bit? How did you fall into what you were doing today? Like,
Yeah,
were you
so
born in that direction? Did you were like, oh,
no,
I
no.
fell into it accidentally, or what kind of background did you have?
Yeah, so my family is all engineers. My mother, my father, my brother, they're all engineers. And it's kind of like, I guess it was almost paid for me, but that was never really my calling. I flirted with the idea of law school when I was a kid, prepared for the LSAT. And, I actually looked at some law schools locally. I was a business undergrad, so they forced me to take accounting. And I just fell in love with it. I mean, the debits and the credits and how everything had to balance, and it just made sense. Meanwhile, I was reading, reading articles in the New York Times about how the unemployment account for accountants was like less than 1%, which is considered full employment in economics terms. And I just said, hey, this is going to work out for me, and I did it, and I did it pretty quickly as well. When I got my CPA and MBA at the same time, so I would I would study for the CPA exam in the morning and go to work and go to grad school at night. So it was a pretty hefty schedule for a while. But, it's a story that I share because accounting was like the last thing on my mind when I was, fresh in college or whatever, but just fell on my lap. And it's been great. It's a great field and encourage people to look into it. Absolutely.
All right. Well, that's great, man. And so, your family of engineers, I guess, and then now kind of, doing what you do. And any relation now to some of your success and seeing all of this come together?
Well, I mean, yeah, I think so. I mean, discipline. I mean, growing up, I mean, we always place like a strong emphasis in education. I'm a big promoter of education myself. I just believe it's like the panacea to a lot of problems we face. So whether it's law, CPA, engineer, whatever it is, I mean, I just personally believe that somebody changes their passion, they're gonna be successful at it. Even if their passion is, especially if their passion is real estate.
Yeah, I love it, especially if their passion's real estate. You know what? I agree with you 100%, man. I think education, when you have a passion, you're trying to really go after it. If that, involves, for yourself, a way to create some wealth, and if we figure out how to, educate ourselves, whether it's engineering or accounting or wealth creation or real estate, whatever that is, man. If you don't know how to do something, there's a ton of education, ton of knowledge, ton of wisdom out there for us to kind of go and follow suit. Somebody's technically already done that, and if we can figure out how they did it and kind of reverse engineer it, right, then we can go do it. Go do it the same.
Absolutely, yeah. And I had a lot of mentors, and I look forward to mentoring other people as well. I mean, next generation of CPAs and engineers, and they're waiting So we welcome them into the field. Absolutely.
All right. Well, thanks, man, for the bit of background. So, obviously, deal with a lot of real estate, investors, a lot of entrepreneurs, probably a lot of also high earning income earners that are looking for ways to create extra streams of income. So, man, maybe we start there. It's tell us a little bit about the different types of clients you have. Why do they come to you? Who are they? What do they do? And maybe we'll kind of head down that path from that
Sure.
perspective.
So yeah, I have a variety of clients. I have a lot of business clients in particular, and a lot of them have successful businesses where they're running and making money, and they're looking for that additional investment. Some of it's tax strategy, but a lot of it is just looking at supplemental income, passive income. And when I say passive, the first thing that comes to my mind is real estate. Because for most people, real estate investment is considered passive income. And there's special tax rules and implications that come with that, which we'll talk about, I'm sure. So, I mean, a lot of my clients are successful entrepreneurs. They have their own businesses, their own S corporation, and they're applying and they're investing in real estate on the side. Started with one real estate, but now they have like five, and some of them have a lot more than that. Depending on how long they've been kind of dabbling into the market. I'd like to think that one thing I believe that I offer that a lot of CPAs don't is just customer service. A lot of times, people email their CPAs and they don't respond, they don't call back. It's just frustrating. I don't do that. I'm pretty good in response time, and sometimes the client just needs to get on the phone and talk with you, and that's kind of like what my niche is. It's something that I offer, and kind of reason why I have like a strong, loyal client base.
Yeah, makes perfect sense. So a lot of those business clients looking for additional, supplemental, passive income. There's a difference between ordinary income, active income on one side, and then passive income, right? Even from the IRS standpoint, we throw the word out a lot. Passive income, additional streams of income, supplemental income, some extra side cash coming in. But man, the main reason that people throw those terms out a lot is they say, or one of the reasons that I hear those terms a lot are millionaires. Multiple millionaires will say, hey, the number of streams of income they have is 7+ is a magic number. If I can have more than 7 streams of income, then the millionaire kind of mindset just kind of over and over and over again. But what's the difference between IRS standpoint, active income, ordinary income, and passive income? Let's break that down for a little bit for
Very, very different. And we also have capital gains, which is something that's also being treated differently. So ordinary income is the actual terminology, and ordinary income is essentially the income that you rely on for a business owner. Let's say you have a business owner who owns a construction company. His ordinary income would be the proceeds through his construction company. That would be his ordinary income. Now, passive income is something that is a source of income that is kind of like, as the name suggests, it's passive. You're not actively involved in it. And real estate is the example that generally comes to mind, although real estate is not the only example. Now, unless you're like what we call a real estate professional, real estate investment becomes passive to you. Now, that has significant implications, especially in case of real estate, because a lot of times passive income is income. But real estate, often due to the depreciation, which is non-cash expense, you end up with a loss on real estate. Even though you have a positive cash flow, you have negative tax implications. Now, if it's passive income, then those losses are considered suspended and carried forward for subsequent years until the real estate property actually starts to produce income. This can happen often, with like old rentals, right? If you have a rental that you bought in 1982, by now you're probably reporting income, but you may have some suspended losses that are carried forward. So that is a huge thing. Now, there's some exemptions related to that, and for real estate in particular, which we can talk about. But that is a significant difference between passive and ordinary income.
Yeah, there you go. So ordinary income, I'm a business owner. I own a corporation, C corp or S corp, or any kind of entity that I form. Right, it's creating income, and when I'm a W-2 employee, much the same.
Correct.
Ordinary income. It's my income that I get from a source of a check. Right, I go to work, I trade my hours, I'm actively involved, and I get a check coming in. Now the passive income, right? Or passive income, as it suggests, a lot of times real estate is what Nima mentioned, right? If I invest, 200 grand into a property and it kicks off a little bit of income, it's passive because that's the way the IRS deems it. So it's treated differently from a tax perspective. You mentioned something specific, which is unless you're a real estate professional, right? And which we can't write off the full depreciation. But if I'm a real estate professional, then something else gets unlocked and I may be able to write off more, right?
That's
So,
correct. So if you're going back to what you said, absolutely.
yeah,
So in your example, for example, if I were to invest in your corporation, that would be an example of passive income, right? Because it's not something that I do. And
yeah, I'm
correct,
active, you're passive in it.
that's correct, exactly. And a real estate professional is a game changer when it comes to real estate because at that point it's no longer considered passive; it's considered ordinary. So what happens is when someone who's a real estate professional, if they have enough rental property, at some point they will be allowed to take those losses against other ordinary income. Whereas like you or I, on the other hand, would not be able to do that. Our losses from our real estate properties are considered suspended. But if we were real estate professionals, then we can take the rental loss from the real estate and offset the S corporation income with it, and essentially, in a lot of ways, wiping out the taxable income that's associated with other sources of income besides real estate.
Yeah.
So the hurdles are there, but if you can get there, I mean, it's a game changer for sure.
This is probably the biggest chunk of investors for us in our syndication. So we invest in multifamily syndications, heavy in San Antonio, Texas, and South Texas, and almost 1,700 doors now. And we have a lot of investors that are seeking passive income. They want to create additional streams of income. They like real estate. They want a double-digit return. They don't want to do any of the work. And they want some good tax benefits. And a lot of times it's a high earning professional or a business owner that has a spouse. The spouse is not working or not making as much money. And there's a huge opportunity for most of those investors when they say, when they realize this is my spouse is not going to work anymore and staying home. And then they're become the real estate professional and they're chasing and they're actively getting after it. But they realize, as an investor, they can invest in it and then write off these, quote unquote, passive income, and it flips to the ordinary side, or I guess it flips to the ability for them to capture depreciation. Correct. And write off the other person's W-2, right?
That's absolutely, and you made a good point. If your spouse is considered a real estate professional, then so is the family as a unit, right? And
the family as a unit. That's a great way to say it. It's not as an individual, right? If we're filing jointly, our family as a unit now can take these, passive and make them ordinary, right?
That's correct.
Man. So in your book of business, your clients, do you have a lot of people taking advantage of this, or
the tests to meet that are not exactly easy, right? I mean, I have generally, when they get a few rental properties, we start strategizing on how to meet that criteria. Okay. Often it's not like an immediate drop, but it might be, okay,
you're in a few properties now.
Correct. They'll say, I plan on getting 3 more properties this year. I'll say, okay, what about getting a real estate license and becoming more active and possibly saving yourself money because you can close your own transactions now. You don't necessarily have to pay another. I mean, all this comes along with tax planning, and it's often something that you put in on the horizon over like the next 3 years. Mm-hmm. But a lot of my clients are, like I said, high earners. They're making money from other activities, and the more you make, the harder it is to meet that threshold. So it's just something that to consider as well. But then again, I have clients who are real estate agents and have their own properties, and those are often, a lot easier to qualify as real estate professionals as well.
Yeah, that's awesome. Well, anybody that's looking to try to figure out how to qualify, reach out, and somebody like Nima, a professional that can give you some guidance on it. So yeah, that's awesome. My personal story, Nima, was like a game changer for me. It was the first time that I really realized we can make massive leapfrog events above and head and shoulders above where I was investing. So I was investing in a lot of single family deals. We had about 10 properties at the time. And our first syndication, we moved some of our IRA money, 401k to IRA. We kind of did that, and it was like passive. It was cool, but it was the first $100,000 cash investment. At the time, I was a W-2 earner. I was making about 300K ish, somewhere in that, give or take. But my tax bill was like 60 something thousand bucks. We put in 100K. We wrote off like $69,000 of passive losses. My wife stayed home from the W-2. She became the full-time real estate professional in the house. And our family as a unit, we wrote off the 60 something thousand dollars of taxes. I got all our like 30K back in from with the holdings. I negated all my taxes, and I was like, oh my gosh, this is like manna from heaven. This is like 100K I didn't even know I had. And there I was investing, and it was easier to do it again and again. And I was like, oh.
I recently had a consult with one of the largest real estate professionals in the Sacramento region. And, when I looked at his tax return, it was like a huge loss. And it was all because of depreciation. It wasn't like a cash loss. I mean, these properties are all cash flow positive. It's just because of depreciation that, they were able to produce a loss. And like you took advantage of that the criteria. Once you hit that criteria, it becomes a game changer for sure.
There's the first book that I read about this was Rich Dad Poor Dad, purple and yellow book. If there's anybody on my show that's listening that just by chance has not read it yet, you need to go pick up the book. And one of the main things I took from it was this corporation mindset. Taxes are going to be one of the biggest bills we pay in our lifetime. And if we can figure out a way to spend money first, then get taxed afterwards, like having our corporations, having those expenses in there first, then pay taxes on the difference, as opposed to as an employee where I would pay taxes first and then spend the difference. It was a game changer. I go, okay, cool. Well, what about this corporation status? So tell us a little bit about, how some of your clients, some of the strategies that they use for deploying those corporations, and how they save in the tax game as business owners and entrepreneurs.
Yeah, I mean, you hit the criteria even became more important when they got rid of the Form 2106, right? Because in the old law, even employee could write off non-reimbursed expenses as an itemized deduction, subject to 2% of AGI, but they changed that. So now if you're an employee at the federal level, you don't even get that. So it becomes even more important to be able to take, to put yourself in a situation, as you stated correctly, to spend before you pay taxes. And in terms of what everything, right? I mean, whether you like it or not, you use your business, you use your phone, you use your car for work or whatever it is. So if you're in a position where you kind of have your own company, you can plan in terms of tax strategies, in terms of deferring income. That's often what we do. We have clients that we run payroll for them once a year and simply just max out their 401k and defer the income. Then cars and telephones and anything else that you use for business that you would otherwise not be able to deduct as an employee, you certainly can as a corporation. And then recently, one of the more significant impacts is the pass-through entity tax, which has been passed, at least in California and some other states. Your viewers will have to check with their own state, but it is a strategy where if you have a pass-through, like an S corporation, you can essentially have the pass-through pay your individual income tax. And that's, of course, because of the SALT limitations that were placed in the 2017 tax reform bill. limiting state and local tax to $10,000. Well, if you're making, in your example, if you're making 300 and you have your own home, you're well phased out of that. So I mean, you could be losing $80,000 in deduction because of that. And if you have a pass through, whether it's a partnership, LLC, or an S corporation, you can take a huge tax hit. Now, comes with a level of responsibility. I tell my clients that none of this is free. You're gonna have to work for it a little bit, but with the right tax advisor and right strategy, you can save yourself a lot of money.
Yeah, that's it, man. And more money we save, or the less money we pay taxes, right? The more we can keep going and invest it, and it creates this virtual cycle or this positive snowball event where we have another stream of income, creating some more, a dollar bills coming to a bank account, which without our extra time, effort, and energy going into it, because there's only 24 hours in every day, right? Every family still has, responsibilities, and we want to spend as much time as we can with kids. We don't want to just create extra income so that we forget the reason we were working so hard, right? We want freedom, we want time, we want that enjoyment back in our family time. So man, that's the big goal. That's the big goal, brother.
Absolutely.
Well, good. Well, Nima, from your perspective, for the real estate investors that are listening, maybe your ideal kind of target, right? Which is, hey, you're a business owner, an entrepreneur. You have you have a corporate structure set up. You're leveraging it the right way, and then you started investing. What are some of the maybe the strategies for them to kind of think about? Maybe 2 or 3 ideas to kind of spawn some ideas or thoughts for somebody to say, oh, you know what? I've never heard of that. Let me look into this. Let me try to figure that out. What are some of the strategies that you're seeing, people, save on taxes or building wealth or just leveraging right now?
Sure. Well, right off the top earlier, I had mentioned that in terms of passive income, there are some exceptions to real estate. And one of the exceptions is that if you can keep your AGI between 100 and 150, then up to $25,000 of the loss of the real estate properties can be considered non-passive. So you can
AGI, adjusted gross income, right?
That's correct. Adjusted gross income. Right.
Okay.
And a lot of times, if you have a company, you might be able to do that by purchasing vehicles, right? So you may purchase a vehicle. If it weighs over 6,000 pounds, you can write off the whole thing at once and possibly bring your income down to the point where you can take advantage of some of these real estate loopholes, which the 25,000 passive activity loss limitation is certainly one of them. So that is one that, a lot of times people are phased out of that, and when they are, there's really not much you can do about it. But if you can strategize and get the equipment you need and the trucks you need and write off the income to the level that you need, then you can actually benefit and be treated like a real estate professional up to a certain threshold. And like me personally, real estate investment is not just about you. This is generational stuff that we're talking about. And I'm sure we'll talk about that later, but this is not just about
right now is a good time, Nima, because we me and you, we were talking about it before we, just having a conversation before we hit record, right? The generational real estate, generationally, kind of thought process. It's not, like you said, not just for today, but we're thinking about generations. So man, this is a perfect time to break into it.
Yeah.
Tell us a little bit about what that means and how you help others.
So when it comes to real estate investment, it's not just about you. It'll save you some money for sure, and it'll bring in some cash. But the real benefit goes to your offspring, right? It goes to your grandkids and children and grandchildren and so on. And the way it works is this, right? So you have depreciation. Your income comes in, rental income comes in. You have depreciation. You write it off. You end up with a loss. We talked about that. Now, if you ever sell the property, then you will face what we call depreciation recapture. That's why a lot of times people sell the rentals and now all of a sudden they have an $80,000 tax bill, right? But if you don't sell your property, you keep your property and you pass it as inheritance to your kid, then your kids get what we call step-up basis. So basically what that means is, one, the property is now assessed at fair market value, and two, the depreciation from the past is basically wiped clean. So you get a rental property, you have it for 20 years, you're writing it off, writing it off, writing it off. By the time you get old, you have very little basis in that property. You pass, you give it to your kids. Now the same property that you bought 20 years ago for $200,000 is now worth $800,000. So now your kids get to write off $800,000, right? And they don't have to worry about depreciation to recapture. So this is like a vehicle that's handed from generation to generation to generation. And if done correctly with tax planning, it could be done almost tax-free. I mean, it literally could be done almost tax-free if you plan accordingly and you have the appropriate advisors. So you get cash, you write it off, there's no taxes involved. Not only you get into cash flow with no tax implications, but the asset itself, even though you're depreciating, the asset itself is actually appreciating, because in the long term, property, real estate goes up. It only goes up in value for the most part. So, then your kids end up getting it. It's just a beautiful thing. It's a very, very beautiful thing.
Yeah, I love it, man. I love it. That's from the mindset of, generational, it's, we're trying to level up. And I would say, I'll speaking personally from our family, my dad was, one of, I think, 8 brothers and sisters, my aunts and my uncles, and my grandma and grandpa, bought I think it was a 2-bedroom house, and they lived in that all the years since they were in high school. And I go, man, 8, how did 10 of them, get in there? It was like mom and dad and the littlest ones in one bedroom and all the other brothers and sisters in the other. And that's the way they grew up. It was here in Southside San Antonio. And we drove by the house a couple times, and they kind of showed me, hey, this is where we grew up. You remember that? And that was the first generation, that came through that. My dad bought a rental property, 2-bedroom house, and he rented that out. And I remember seeing that part of it, which is like, oh, something about me we should buy real estate. But the generational part, which is my dad's there, and working hard, and he's in his 70s, so never quite got to that level, that financial freedom. But the house I grew up in was way different than what they grew up in. My dad and mom gave us a great life, great childhood, and they pushed us up one step up this generational, kind of upbringing, which, man, we didn't need for anything, right? Middle income, I was, say probably by most all standards. And now as we're trying to figure out, oh, we live a pretty good dang life, and my children are a step ahead. And man, I think when they get older, we would love to be able to say, here's a portfolio, here's the properties, here's, the avenues to pay for college, here's the avenue to pursue more of your dreams, not to just worry about money, but to figure out how to go live the lifestyle they want and have, income coming in, and who knows what their generation is going to be like. So I think that's a big part for us. And I would imagine there's a lot of listeners and, that are probably in the same mindset. What about you? A lot of your, you and your family the same, Nima? A lot of your clients, is that kind of it?
Yeah, I mean, you're talking to someone who's first generation American. I was born abroad myself. I had to learn English growing up. So it's definitely something that my brother and I are keenly aware of. My brother, like I said, is an engineer. We bet heavily on education. It's paid off, and this is something that we're currently doing. I mean, we've got kids, so we're looking at getting more properties and more assets and sending them in the situation. And it doesn't have to be a big step.
Yeah.
A little step from one generation to the next generation is all it kind of is all we're seeking. So like you said, if we make their lives just a little bit better, they make their kids' lives a little bit better, a little bit better, and a little bit better, then that's what the American dream's about, right?
Yeah, baby, get it on, man. Well, that's it. It's a little bit better. Just take one step forward, and if you're younger or older, just never started, whichever camp you're in, just take the next best step in front of you. Take the next, positive step that you can, whether it's a little education. If you're listening to this podcast, go back and take some notes, whether it's, some other educational, platform that's free right now on YouTube. all kinds of different educational platforms to create some income, to create this cash flow, to go buy some assets, reduce your expenses, and get some personal financial statements filled out where your net worth, you see it going up and to the right, man. So go do it, go make it happen, right?
If I may add to that, just make sure you get some tax planning, because I've seen people with some nice portfolios of real estate and they've placed them all in the corporation. Bad idea. So just make sure you get some tax planning as well.
Tax planning. There you go. Get it on. Hey, Nima, thank you so much for your time. For those individuals that want to be, get step closer to you, learn a little bit more about you and your services and that kind of thing, who do you want to reach out to, and where should they go? Where do they go to contact you?
Well, I mean, I'm on LinkedIn, Nima Rezaei, CPA, MBA. Also, you can email me. It's nima@nimacpas.com. But yeah, in terms, I deal with all kinds of people. A lot of them are, like I said, high net worth individuals. But at the same time, I try to do some pro bono work as well. I try to give back to the community best we can, because this is our community. And at the end of the day, we want to do what's right, and we want to help people so that they can kind of come up as well and reach the next generation. Business owners are obviously, if you guys have any questions. Non-business owners, I'm also available. Anything I can do to help the community, I certainly will.
All right, Nima, thank you very much for your time. For those that learned something, go to our show. Go to Apple reviews is probably the easiest way. Click like, click subscribe, leave a 5-star rating, put a written review to let us know you were here, and go reach out to Nima. I would appreciate it. And thank you very much. We'll talk to you soon. See you on the next show. See you, Nima.
Thank you very much, Ed.